Shares of Zoom are having an interesting reaction to the company's earnings report. Late last night, we saw the share price pop a little bit. Today, we are seeing the share price fall and decline. What happened this quarter that has Wall Street a little bit confused? Here's everything you need to know in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do own shares of Zoom, approximately a $20 billion market cap company, about a $19.5 billion today. This is the period Q2 of fiscal year 2024 ending July 31st. Revenue for the quarter grew 4% to $1.139 billion. That exceeded Wall Street's estimate and the high end of management's guidance. Earnings per share on a non-GAAP basis came in at $1.34. That blew past Wall Street's estimate and management's own guidance. Likely the reason why shares popped last night. Good top-line results. Digging into the quarter a little bit more, total revenue grew about 4% year over year, and enterprise revenue grew 10%. Enterprise revenue now makes up 58% of total revenue. That continues to march higher. We do want to see that trend continue as it has been. Online monthly churn, that dropped down to 3.2%, so that's for regular everyday customers. So churn is heading in the right direction as well. Interesting to note, revenue this quarter was actually mixed. So in the Americas, it actually grew about 6%, declined in international markets. So that is something to keep an eye on. Enterprise customers, the customers we truly care about, grew 7% to 218,000. The number of customers that are going to spend at least $100,000, that grew 18%. So customers are spending more, good to see. And the dollar-based net expansion rate was 109%. Now, if you're curious how the company could have an expansion rate of 109%, but only grow its enterprise revenue 7%, that's because this is an expansion rate, which does not include churn. That is different from the net dollar retention rate. If you're confused about that, just click pause and study this chart that I made a little bit more closely. Digging into some other results, we saw remaining performance obligations grow 9%, both current and non-current. One thing to keep an eye on is deferred revenue actually fell 2% this quarter. Management noted that customers are holding on to their revenue a little bit longer and not prepaying as much as they used to, which makes sense given the higher interest rates that people are seeing. Why prepay for a product when you could keep it on your balance sheet and earn more interest today than you could a year ago? Period. So not a big trouble sign yet, but something to keep an eye on. Now, Zoom does a great job of sharing information with investors. So we see that those customers spending $100,000 each on the products continues to grow quite nicely. They now represent 29% of total revenue. That continues to grow up. The expansion rate for those customers, though, has been coming down. In the pandemic, 139%, just stellar results, 109% more recently. Hopefully this number will stabilize and start growing again, and churn is trending in the right direction. Turning to margins were pretty good. On a GAAP basis, gross margin increased to 76.6%, higher on a non-GAAP basis. And on a non-GAAP basis, both operating and net margins are truly outstanding at 40.5% and 36% respectively. Now, on a free cash flow basis, free cash flow nicely jumped this quarter to $289 billion, as did non-GAAP net income. Balance sheet here remains perfect, $6 billion in cash and zero debt. Zooming in on margins a little bit more, you can see that there's a pretty wide gap between the GAAP results and the non-GAAP results. So GAAP gross margin 76%, that was up. Non-GAAP basis 80.3%. The big driver there is stock-based compensation. We did see that R&D expenses actually grew year over year on a percentage basis, so the company is investing quite heavily in R&D, continues to. Sales and marketing and overhead costs were down though, so that is interesting to see. On the income statement, you see this a little bit more closely. So R&D expenses continue to grow, but overhead and sales and marketing, they are pulling back on. One thing to note is that this period did include some gains on strategic investments, whereas in the year ago period included some losses, and the company's non-operating income grew very sharply, likely due to the cash balance on the company's balance sheet, plus higher interest rates. It's also worth noting that the diluted share count fell by about 1% year over year, although the basic share count actually rose year over year. So that's the effect of some buybacks taking down the share count year over year. Good to see that, given this company still pays pretty high stock-based compensation. Although it is worth noting that the company did not buy any stock back this quarter while spending almost $300 million last quarter. That has me scratching my head a little bit because the valuation, as we're going to see, is pretty darn low today. Why isn't this company buying back stock when it has so much cash and no debt? A bit of a head scratcher. Turning to guidance for both the fiscal year and the full year, here's how the company presented it. Here's how we view it. So revenue guidance for the upcoming quarter, revenue growth of just 2%. Wall Street was looking for 3%. This is likely to be the big reason why shares are declining today. I mean, management did just pretty much beat its own guidance, so I'm guessing that this is a conservative number, but that could be a reason why shares are declining today. On an earnings per share basis, management is basically calling for flatness. Wall Street is expecting a decline year over year. Again, they just blew past their earnings per share guidance, so I'm not sure what's up there. Now, for the full year, management did raise its guidance. They're now expecting about $4.49 billion, 3% year over year growth, better than Wall Street's estimate, and 7% growth on the bottom line, much better than the 2% loss, 2% decline that Wall Street was expecting. So the long-term guidance looked pretty good here. Running this company through our quality systems, it continues to be in both of our investable categories. Now, thinking about valuation, this company is optimized up and down the income statement. So where is it on the business growth cycle? It is clearly here in the capital return phase. So there's a number of ways that we could value this company. Let's start by taking a look at the price to trailing earnings and price to free cash flow, doing some basic multiple analysis, and we're going to do that with the sponsor of today's video, which is YCharts, a fabulous tool that we use all the time. So here is Zoom's price to sales ratio. This figure peaked at 124. 124, just crazy to see. It's currently about 4.6, so just slightly above its all-time low price to sales ratio of 4.1. On a gross profit basis, this company's trailing 12-month gross profit is about $3.3 billion. Compare that to the company's market cap. It's trading for just under 6 times price to gross profit. Pretty darn cheap. Now, the trailing PE ratio is not that useful here, but if you look at the forward price to earnings ratio, trading at about 15 times forward earnings. That is not pricing in a heck of a lot of growth. Similar story on a price to free cash flow basis, currently trading at about 18 times price to free cash flow. So not very high valuation on a multiple perspective. If you guys want to check out YCharts, just mention my name off at checkout. There is a link in the video description, and you can save 20% off of your purchase. Thank you to YCharts for sponsoring this video. Now, another option that we have is the reverse discounted cash flow calculator to value this company. So let's take a look at that. So if we type in, using our spreadsheet that we created, Zoom as the ticker symbol, the company's free cash flow on a trailing basis is about $1.1 billion. If we assume a 2% terminal growth rate and a 10% discount rate, that means that the assumed growth rate has to be about, let's call that 5.9%. Yeah, those are roughly correct. So at today's price with a 10% discount rate, this company has to grow its free cash flow about 5.9% over the next 10 years to justify today's price. So I leave that to you. Do you think that a 6% growth rate in this company's free cash flow is achievable over the next 10 years? If so, then today's price looks quite attractive. If you think that's still overselling this company's growth potential, then perhaps it's more closely to fairly valued. This company has new products coming out. It has a huge cash hoard, remains a founder-led business, and I don't think today's valuation prices in a heck of a lot of things going right. So I am a shareholder. I have no interest in selling this stock anytime soon, and who knows, I might be buying this stock in the near future. We will just have to see what happens. Hope you enjoyed this review. If so, please click the like button, and in the video description below, you'll find links to both YCharts and, if you're interested, the reverse discounted cash flow calculator tool that I just used. You can download that for free. Thank you for watching this video. See you in 90 days on this one. Brian, out.